But let's speak about a particular pocket, that's the non-banking financial space. The companies are likely to witness an increase in the 90 plus day delinquency levels, says a report by ICRA. The report also states that while some key asset classes like loan against property would register an increase in delinquencies, others like tractors and construction equipment are likely to see some reduction from their peak levels. To discuss the report in further detail, joining us on the phone line is Karthik Srinivasan. He's Senior Vice President and Group Head of Financial Sector ratings at ICRA. Karthik, good to have you on the show. First of all, take us through the broader contours of your report. You say that the stress levels or the delinquency levels for some of these NBFCs might go up in a range of 20 to 50 basis points.
Yeah, what we've said in this report is, in terms of the asset quality numbers, they have been rising. The delinquencies have been rising over the last couple of quarters. At a broader overall NBFC level, we are saying that if we were to exclude the MFI sector, the numbers are sort of stabilizing close to 4.8, 4.9 kind of a level. But given the challenges in the economy still, and there are obviously some pressures and pain points at the underlying borrower level, so we do see some more rise on the 90-day DPD for the sector as a whole by the year end. Within this, there are some segments like LAP, to an extent MFIs, where we think that the numbers are continuing on an upward trend, whereas other segments like a tractor or a CV or a gold loan segment, where numbers are either stabilized at the current levels or they are improving. So some subsectors we do expect a further rise on the 90-day DPD levels, whereas for the others things should improve. So that's the reason at a net level we are saying possibly the NPA numbers could go up marginally by 20 to 50 basis points. Obviously, it is also supported by the fact that the denominator is growing pretty adequately at about 16 to 18%, which is our year-end target as well. It's lower than the previous year, no doubt, but it's still reporting a healthy growth if one was to look at it in relation to the banking system credit.
What about the loan against property category? You say that you see some spike owing to that category itself. Now, my question is that there's been a big push that has been given to affordable housing in the New Year's Eve address by the Prime Minister in the budget speech, and some of it has been implemented as well. Some traction has been seen by lower ticket size providers, loan providers, while the RBI has tweaked risk weights and provision requirements for higher premium exposures, loans of close to 75 lakhs and beyond. So, how has the market shaped up post these measures? Have you seen a material or meaningful uptick in terms of disbursements, and thereby do you see some repayment risk?
One, let me just say, in terms of this report which we released yesterday, is more on LAP, not really on home loans. Having said that, in the home loans with the RBI relaxation, it's too early to really comment on disbursements. Maybe the Q2 results which would come out by October, that will give some sense as to how things are moving. Having said that, what we are saying is even on the LAP segment, while delinquencies are showing an increase, we are seeing some signs of sort of moderation in the pace of rise of 90-day DPD, which is a good sign. Largely attributed, we could say, to two factors. One, over the last couple of quarters, we are seeing a lot of NBFCs sort of tightening their credit norms, because of the changes in the operating environment. And to an extent, we could say because of the challenges at the banking sector, and the NBFCs are possibly in a better position to pick and choose their clients. But the visibility of those at an overall portfolio level would take some time to really show up. So currently, the impact of demonetization, the uncertainties on the GSTs continue to at least show that the delinquency numbers continue to rise, and could continue at these levels for a little bit more before they start stabilizing or moving down.
You say that credit growth is also expected to remain moderate in the second quarter. Now, what do you have to say about specific names like Capital First or maybe a Bajaj Finance, especially for credit extensions in the consumer durables category? Are you seeing some amount of reasonable traction there?
I wouldn't want to comment on specific companies, but broadly, if you see the reason why we are saying at about 16 to 18% credit is, let's say, subsegment wise, we are seeing a fair bit of traction still on the LAP, which is growing at 20% thereabouts. Segments like CVs, Cs, we do expect, these sectors had taken a sharp beating in the previous couple of years. So there we are seeing that the growth could be in early teens. And consumer durable, unsecured loan at a broader level, because of a relatively smaller base in percentage terms, those numbers could look high. But at an overall portfolio at an NBFC retail segment, we think the numbers which were last year close to about 19% growth could be closer to 16 to 18% growth, again depending on how the second half of the year performs. First quarter has been rather muted as compared to the past trends. We expect Q2 also to be in similar lines. With the onset of the festive season and the second half, there is a likelihood of higher growth in the second half of the year, which should push up the overall annual growth rate for the NBFC retail sectors towards closer to 16 to 18%.
Right, and Karthik, if you can also tell us what do you feel about NBFC credit costs, because there's also mentioned that the NBFC credit costs and operating costs are likely to remain high than what it has been in the past, which is likely to by and large offset the benefits of lower cost of funds. So if you can share with us some numbers as to what you see this at, and till what time do you see credit and operational costs remaining elevated?
What we've seen is, in terms of cost of funds, we have seen almost 50-60 basis points of reduction in cost of funds at an average level for a lot of players over the last couple of quarters. On the other side, with the transition to the 90-day norm by the end of this year, few players have already moved to 90-day norm. Others would move by March 18. That, and also given the environment, we are also seeing some of the players do incremental provisioning as well. Consequent to which the benefits which one would have sought is, one is getting by the reduction in cost of funds could get more than compensated by the credit cost, which we think could go up by an equal amount, at least for the remaining part of this year and possibly the next year as well. So in terms of overall profitability levels, we still expect the overall ROAs to remain broadly in the similar range of 1.7 to 1.8% at a sector level. Obviously,